So we use a discounted cash flow. But rather than using it to generate a price target, we reverse engineer the discounted cash flow in order to derive a terminal free cash flow growth rate that's required to justify the current share price. So for example, in NVIDIA right now, we think the terminal growth rate is around 4 to 5%. And then we look back as far as we can and say, what's it grown at in the past? And what is it expected to grow at in the next 5 years? Nobody knows what it grows at for 25 years. But if we get that margin of safety, so if NVIDIA needs to grow at 4 or 5, and it's historically grown at 10 and is expected to grow at 10, 15, then we've got a margin of safety. And Hermès would be a prime example of this. So Hermès is not a cheap stock. It's a very good quality stock. The implied free cash flow growth rate, according to our model, is 6%, but it's always grown at 12. So we have a huge, so its growth rate needs to halve to justify the current share price. And I think that lets us run our winners for longer. So if we'd bought a Novo Nordisk on 18 times earnings, which we did 3 or 4 years ago, it's now on 28, 29 times. You're almost inclined to sell that stock because it's a lot more expensive on a near year earnings multiple. But what difference does it make what a stock trades on full year 25? We're really interested in that longevity of free cash flow growth. So what it's going to make over the next 20, 25 years. And so if we've got that margin of safety, we're comfortable buying these things.